Okay, in this video, we're going to go through some advanced training. Here's what we'll cover. We'll cover being aggressive versus being conservative, trading inside the RS lines on the chart, trading the breaks of the RS lines, trading near the daily highs and the lows, adjusting for market conditions, hot time frames for trading, finding your trading style, and also reverse alerts. Okay, so with that being said, let's get started. First, let's talk about being aggressive versus being conservative. One of the things you need to know up front is whether or not you like to trade aggressively or conservatively. While you can be conservative, it can cause you to miss out on the beginning of some explosive moves. And if you like to trade aggressively, the rewards can be great, but you can also take a lot of small losses. Neither is bad, you just have to decide which strategy you would like to use. Some examples of being conservative is waiting for the price to break a certain level and then retest the prior level that it just broke. This is known as confirmation. You can even see this in the FXDB system. So let's go ahead and let's take a look at a conservative trade now. This is where we see an example of a conservative trade. Notice that the market broke out on this bar right here, right? Starts to move down. And then it comes right back up before continuing its move down. Another little test right there, and then boom, it just starts moving down in these little waves. Now, if you were trading the FXDB system, you would have gotten a signal on this bar right here. Now, how do I know that? Look, everything lines up. It breaks out of the RS lines. You come down here. It's red on all the lower time frames. And right down here is below the T meter. That signals us to get into the market right there. Okay? Before you just entered the market, a conservative person would have said, well, if it breaks the low of this bar, I'm in, or I may wait for it to break and come back up, pull back up and try and retest the area it just came out of, right here, out of the bar just broke, that was right here, and then start to move down. So whenever you're using a conservative method, you see the price breaks out. Instead of just getting in when it's saying, oh, it might move, you wait for the market to pull back and retest the area that it just broke right here. So once again, confirmation, conservative trading is seeing that it breaks out of the area, makes a little move down, and then it pulls back like it does right here on this bar, and doesn't quite make it back up. And then from there, looking at the area that it previously broke out of, that's where a conservative trader will say, okay, now that it could not get back in the area that it just broke out of, now I'm going to enter the market once it breaks that area again. And obviously it retests right there, but it couldn't make it back up. So what happens? Boom, it starts moving down. You could have gotten in right there at the retest, or you could have waited until it broke the candle that tried to retest, which is this bar right here. Follow the 3-bar stop. That's right there. Now, if you would have gotten in right here, you would have got stopped out right about there. But that's one of the things about trading. Depending on the time frame that you're trading in, this is one of those times where I would pretty much just kind of manage the trade myself. I may want to give the trade some breathing room, right? Because if I don't see a fast move just down like that, steep moves, then I'm expecting price to do this, just to make a lower low, come back up, make another lower low, and just keep that pattern in place. You can see obviously it gets all the way down here. Now that's what happens if you're conservative. Now let's talk about being aggressive. When you trade aggressively, you might not wait for a retest sometimes. You base your strategy upon whether or not the market may bounce off a certain area before continuing in the other direction. Or you identify strong support and resistance areas on the chart and you place orders to take advantage of those areas. Let's take a look at some examples now. Okay, let's look at this area right here. If you were aggressive and you saw the market kind of bounce down right there and then start making its way up, come off, you see that this bar right here couldn't continue up, so now you know there's resistance in the market. So now what do? At this point, if you're aggressive, you may say, okay, I'm going to wait for it to come back up retest this area, and I'm going to put an order in to bounce off this resistance line right here. Now this is an aggressive tactic. Some traders like to do this, some people don't. The premise of the tactic is to set an order to bounce off of there and take a very small stop loss, maybe 20 pips maximum, in anticipation that on the previous bars you see that price could not break a particular resistance or support area. In this example, we see that it comes back up, retest this resistance line right here, and then start making this move down. Comes back up and pulls and then continues down. Now, if you're an aggressive trader, this works sometimes, sometimes it doesn't. In this case, we can look right here and see if we'd have placed an order to go back to the upside, we would have got stopped out. Now, these are just totally aggressive moves. It's just totally taking a position stating that, okay, based upon the previous moves, the previous bars, price couldn't break a certain area. It couldn't move through a certain area. So based upon that, if it comes back up, I'm going to sell. And that's what you see a lot of times in the market. When the market gets to a very strong support or resistance area, immediately you'll see it come up and then boom, you'll see it do that. Make this quick move down, because you have a lot of people that have watched the market. They've seen bars like this where it tried to make a push up, but then it closes back down. And then at that point, they speculate that they're selling at that area. So they put orders in, they put sell limit orders in to automatically sell when the market gets up to that level again. And then you see, boom, you see a big move, quick move down like this to take advantage of that prior resistance level in this example. Or it could be the same with support. Let's go ahead and take a look at an example for support. Okay, so here we are. Let's focus on this example right here. Now, all trades are not this clean. I have to let you know that they're not all this clean. But what you can see sometimes, okay, the market makes a push down and then boom, it makes another push up. Okay, so we see that it couldn't break out right there. So boom, if it comes down again, I'm going to buy right there and maybe place my stop, 15 to 20 pips away, because I don't want to take a lot of risk in anticipation that the market's going to move right back up. Now, before I take that trade, I may come in and measure the distance of the range. See that there's 50 pips for potential profit. So now I'll look and say, okay, 17 pip stop loss, just in anticipation that the market cannot break there. Okay, and you'll get people buying right there. Once they've identified a very strong support area, some people will automatically set orders to buy at that support level again. And then you get what you got right here. Boom, move up. And it stays in the range, but eventually you get this right here. Okay. Now that's an aggressive tactic. An aggressive tactic doesn't wait for a retest a lot of times. Sometimes what it will do, it will take the bounce off of certain areas, or it will wait for the market to close outside of that area and then immediately enter on the break of that bar that closed outside of a particular area, whether it is resistance or whether it is support. Now, as I said before, you have to decide what kind of trader you are. Once again, if you go to the compartmentalization of funds video in the money management section, if you like to trade aggressively and conservatively, I would recommend, once again, not to put all of your account on one particular method, but to divide those funds up so that you can see what works better for you around what time frames. This is just one aggressive tactic. Now, also what you can do, you can come down here and use your indicators for filtering. Use your FXT bars down here, and also use the T meter to kind of give you an indication of whether or not there's momentum in the market and whether or not the momentum is to the direction that you're trading in. Sometimes it will not be perfect, it will not line up, but once again, if you have everything lining up down here, then that's a pretty good indication to say, okay, there's momentum in the market, I want to make a move. Now this can also be a great place where you use the map to kind of help you figure out whether or not the momentum is going to keep continuing or whether or not it's going to reverse. Let's look at this candle right here. Okay, we see it closes out, but then we start getting a lot of neutral candles right behind it. So that's a pretty good signal indicator that, okay, maybe price is not going to continue. And then we can see, okay, like right here, look at what happens. You got the 3-bar reversal indicator on right there. And it's showing us that it's moving to move our stop in the direction of a sell. But then all of a sudden, it breaks out of the range right here. And not too many bars later, boom, you see this. Now it's showing us to protect us in case we were in a buy. That is a pretty good signal that momentum may be reversing. Whenever you see that, if you see the 3-bar reversal starting to form a pattern like that, that's a pretty good indicator to say that, okay, momentum may be reversing. Okay, let's go ahead and let's continue.